Welcome to 2026. After a whirlwind 2025, what can we expect from Canada's economy this year? Beata Caranci, chief economist at TD Bank Group, delves into some of the risks.
Definitely Kuzma is like that Charlie Brown cloud hanging over us. Everywhere we go, it's following us. Some people refer to it as a zombie Kuzma.
And what she's excited about.
Well, I'm excited that housing affordability is improving. I know people don't really feel it or think about it, but it has. Resources, we know foreign investors are asking us when we're talking with our clients, a lot of them are asking us about the resource sector. Anything defense, anything supply chain defense, a feeder into that. That's a tremendous opportunity. It hasn't been there for generations.
The Money Talk Podcast, brought to you by TD Wealth with Kim Parlee.
Hello, everyone. I can't think of a better person to kick off our podcast this year with than Beata Caranci. It is lovely to see you. Happy New Year.
New Year.
How are you feeling?
Physically, I've got that 7-week cough bug that everybody seems to be complaining about.
Yeah.
Intellectually and mentally excited to what the year is going to bring us. From an economic perspective, it has not been a boring 12 months. I don't think the next 12 months will be boring. And I think for when you're a curious economist, as unnerving as it could be that like you're in uncharted territory, it's actually incredibly intellectually stimulating to try to figure it out.
Yeah.
And hopefully give some good advice to clients along the way.
Can I ask, so you talk about, being intellectually curious and trying to build, when you think about 2026,
Yeah.
and 2025 was not boring. 2026 is certainly not starting off to be boring in any way, shape, or form. But when you are a forecaster, and I know people rely on you to say, where you think things are going, this drives investment decisions, no pressure, Beata, all the things. But how do you even begin to start to forecast what you believe Canada's outlook is in 2026 when there's so many moving parts?
Yeah, so like some things you just take off the table because it's too much of an unknown factor. So an example would be Kuzma. We just assume the status quo of what we see today going into 2026 because we just don't know which way it'll break, and you might be too pessimistic or optimistic. Other things like the Bank of Canada, where we feel fairly strongly that they are at the bottom of their interest rate cycle, we don't anticipate an up or down move. The market does have a slight up move by around mid-year this year. We don't. We think they're going to hold the line. And so this is sort of like as good as it gets for people who are looking for mortgage rates and other factors of where we think it'll settle. That is based more on the fact that we look at what the job market's doing, and it's been sufficiently resilient for the Bank of Canada not to have to move. We now have the government, kind of taking up that baton on fiscal stimulus, so it's not all about monetary stimulus. They can pass it over to the other guys in the room, right? And so I think like when you put the pieces together, that is a more forecastable area that we feel a bit more confident on. And then we'll just have to roll with the punches on what comes through on the policy front, as we know with the recent removal of President of Venezuela. Like these are not things that are forecastable. You just adjust to.
Right. So I want to actually, every single thing you said there, I want to dig in on a little bit, but I want to just start with maybe the foundation of where we are. So 2025, if you read the headlines throughout the year of 2025, you would have thought it was the worst year ever.
Yeah.
And a really, really tough year for Canada.
Yeah.
And I know from a conversation that, we've had recently, when you actually look at the data, that's not the case.
Yeah. So there's a few things, right? Like if you look at where policy announcements were occurring, Canada was first targeted by really the United States in terms of tariffs. We had those reciprocal tariff announcements in April, but Canada knew very early on, back in February, that this was not going to be a good day or a good year for tariffs and free trade. And so I think right away you started to see forecasters get nervous, business groups get nervous, and the markdown of expectations. And so there were several, but not us, that were calling for Canada to be in recession by the time we got into that April reciprocal period where you could see all these tariffs. Since then, we've seen a lot of backpedaling in those areas or deals. So these are these envelope deals. They're not necessarily like full-on trade deals.
These are the sectoral ones you're talking about,
Well,
yeah?
There's two, right? Like the country deals that have occurred, only Canada and Mexico as major countries do not have a deal yet with the U.S., but they're also shielded. Companies are shielded still inside the USMCA.
Yeah.
So from a global perspective, we didn't get the hit that that many had feared when you just look at the numbers. Like
Right.
you see what was getting posted of these very large tariff rates across countries. And then within Canada, there's like those Section 232 tariffs on steel and aluminum and other areas in Canada. Those are crippling for those industries, but 90% of exporting, almost 90% of exporting companies are not paying any tariff because they're under the USMCA umbrella. And so, there's this like dichotomy of those who are doing okay and then those who are bearing the weight. Unfortunately, those industries and companies bearing the weight have a geographic distribution in Canada. And so Ontario is definitely a laggard in the economic sphere for Canada, as opposed to what you see in Alberta or even in BC, because they're benefiting from natural gas shipments that we don't have in Canada. So, in Ontario. So there's a lot of nuances, right?
Yeah.
A lot of nuances.
Can I ask, I'm going to ask a long question so you can get a sip of water, because I know you're dealing with a little cough here, but when you think about the single most important thing to what Canada's economy is going to look like in 2026, I think everybody would say it's CUSMA. Is it CUSMA?
Definitely CUSMA is like that Charlie Brown cloud hanging over us. Everywhere we go, it's following us. Some people refer to it as a zombie CUSMA, that it just hangs around, because technically the trade agreement holds until 2036. And so if you do nothing, every 1 year it just keeps renewing unless you've made specific changes out until you get to 2036. So from that perspective, you could have companies stay under that shielded umbrella of the trade agreement and continue to free trade between Canada and the US. So it matters that it doesn't get worse, meaning, Trump doesn't pull more industries under the 232, tariff rates that are as high, 25 to 50%. They're really crippling. But it may not matter that it absolutely must get resolved. I think ultimately there's damage done that, you can't unsee what you saw. And I don't think there's a business out there that thinks that establishing in Canada for market access to the U.S. is guaranteed. And I think that's what we had previously, and that sentiment has gone away. So from that perspective, it's really important. But that is what's not in our control. Like, of course, Prime Minister Carney is going to be negotiating hard on that side.
And traveling and building new deals as he's doing.
But ultimately, the other decision maker is going to be the U.S., so you can only control so much. What I find we should be focused on for this year is what is actually in our control, and that is in our ability to deregulate, improve the business environment, take a look at our corporate tax structures, and make those more pro-growth than they have been, and none of that was addressed in the budget. So there's a lot that's in our control. All these priority projects that have been identified in infrastructure and other areas for development, getting those going off the ground, that's in our control. And I think that's what investors need to see come through in 2026. It doesn't mean you're going to obviously have an LNG facility up and running, but are you making progress on where you expect on permits and deregulation, getting investors behind it, getting capital and money where you expect it to be for the build out in the next few years? Because if it ends up being a dead zone for that in 2026, then we have a real big problem.
So what is the forecast for Canada?
The number is 1.2%, whatever that means to you.
Yeah.
Basically, it's a forecast that is not that much different from what we saw last year. Mm-hmm. So we have very similar, resilient in the sense that it's not a recession, but restrained. It's not where we would like to be. And it is an economy that's going to be building up slack. It's not really using its full potential and capacity. And so that's what we think that forecast for 2026 will look like.
I know you've got a slightly more, and you can correct me, the last time I looked, I think it's 2.25 for 2027 on GDP, I think.
For Canada?
GDP, yes. Canada.
Yeah. When you come off a low, eventually, just the math gives
you bounce back.
Yes.
That's what happens. Okay, what is going to drive the modest growth that you're seeing in Canada, and then maybe at the same time, what's going to hinder it? Like, why do you have that number?
So, in some respects, it's necessary policy. So that's the unwinding of some of the immigration thrusts that we had.
Yep.
This year will be the first in history that we're going to have a contraction in the population in Canada from that policy. And so that would have been a big thrust to consumer spending growth in the past that we're not going to have in the forecast. On the flip side, it's allowing for more affordability in housing, which is exactly why this policy was put in place to do the unwind. But we're not also going to get all the big construction build that normally happens when you have a strong demand market. And so from that perspective, we've had a better year than we expected in construction last year, but which might surprise some to say that.
Yeah, I think, yeah.
But it's in the rental space. It's not in the home ownership space. And that's because the government policies tilted to improving the financing condition of developers in that area. And in fact, some areas that were permitted for condos got flipped into rental units because it was more economical to build those. So that build, about 50% of the housing starts that happened last year were in the rental space. Some of that momentum is going to be coming out of this year as we get towards the end of the year because these projects are off the ground and then you don't get the same push. So those are some of the restraints. Some of the growth will come out of the government. The government contribution to the economy is expected to be the strongest, basically, of all the areas within our economy. The low interest rate over time will benefit housing. So we don't expect a strong rebound in housing, but we are expecting troubled places like Ontario and BC to put up double-digit growth in sales. So by that, I mean like 12 to 15% growth in sales. Now, starting points matter because that still leaves both markets about 30% below the peak. So there's a lot of slack still in the market, and it's not going to be a market that's going to have prices popping by any means, but still it's contributing to growth. We're moving our feet in the right direction and absorbing some of that slack. So there's positive and negatives. And then a little bit of the unknown factor, which is in our forecast and not in our forecast, is business investment. So we're hoping for a better outcome on business investment. But we haven't put into our forecast some of the areas like defense spending by the government because we don't have a clear line of sight of the timing of procurements and build-outs of infrastructure on that front. So that could be a possible upside to our forecast. We think that could add about 20 basis points to the forecast, depending on what we see. So that's an important area. It's a hard one to predict, Kim, because when you look at currently how the defense industry procures, about 50% of it occurs from other countries. And so therefore, there's not quite an economic multiplier in this country if you're bringing things in from other countries.
However, if they want to build here, or hope to,
if they build, and then you have to make sure, well, there's two components because you have infrastructure. One of the areas where we have a lot of infrastructure to build out is in transportation, armament, cars, things like that. So that's great. But then there are areas where we want to move into that we don't have as much capacity. And so, yes, you eventually put in facilities, but that might be more of a story for the future. And then we've done some deals, like we have an agreement with the EU on procurement back and forth between the defense industry. So maybe we get, while we procure abroad, we also provide more abroad. So that's a possibility too. So there's a lot of different things happening in this industry, and we don't have it in our forecasts. And it's possible that it gives a lift to the forecast because we're starting from nothing in there. So I'm optimistic about it. But we need to see exactly how all these factors start to play out.
Yeah, I mean, it's interesting because when you think about the military industrial complex in the States and what it brings to that economy, I mean, it's massive. However, this is kind of comparing an elephant to like a tiny little mouse in terms of what has to get built, but the opportunity could be quite interesting.
Yeah, like the U.S. spends, I think when I looked at it, something like we're moving towards a target goal of spending about $1,200 per capita on defense, whereas the U.S. is already at like $2,400, somewhere in that range per capita on defense, so significantly higher.
That's bigger than I thought for Canada, though. That's a big number.
Well, it's moving towards.
Yeah.
Our starting point was actually around $750.
Yeah.
So that's where we expect to be in the next 2 years. But multiply it by the amount of people in the U.S., 10 times more. So they're spending about 1,000 more per head, and then times 10 times more population. So to your point of how much stimulus you can get out of an area that's known for innovation, high capex, all of which have high economic multipliers because of just the amount of capital and people they use.
Yeah. Again, you always say six things. I'm like writing them down frantically. When you talk about Kuzma being a zombie deal, is that almost a best case scenario, one that just kind of bumps along and then gets deferred until at some point,
ends?
Well, until some point where maybe there's a change of power or there's a change of, those types of things. I mean, what is I guess from your perspective, what is the best we can hope for? The best we hope for is, a great deal negotiated to our side. Some would argue that with some of the changes that have happened recently, that maybe we've lost a little bit of leverage. Again, I'm not in those rooms. I don't know. But when you think about maybe oil before played a bigger part, now it doesn't, other resources, those types of things. What do you think is the best case scenario?
So I think the best case is to get those Section 232 tariffs down, because those are really crippling. Steel, copper, aluminum, autos outside of Kuzma. So, these are 25 to 50% tariffs. So the extent that those could be slashed would be beneficial for those industries, because as much as we would like to reorient Canadian supply chains to Canada, right, and the defense industry, for example, using only domestic steel, that takes time. And so I think that's the best case in the near term, is to get the most egregious tariffs down.
I'm just going to interrupt because one thing that you noted in a report that came out is you are seeing some policy shifts in the U.S. where the Trump administration is removing some tariffs on things like food, maybe to help with their inflation problems that they're having. So do you think it's probable we could get some of these Section 232 things removed?
One would think that holding them at the levels they are will continue to put pressure on the U.S. in terms of let's take a look at what they just lowered on January 1st, on New Year's Day. They reversed policy on lumber products or wood products that they were supposed to have tariffs rise in the U.S. These are like furniture and vanities and those type, like wood products, derivatives of wood. So they put a stall on that for 1 year. It's still there, but for January of next year. Why did they do that? Well, because the housing market effectively in the U.S. is acting like it's in a recession. It's really struggling. It's losing workers. It's stalled out on construction. The cost of build has gone up significantly, in part because of steel, aluminum, copper. These are all the areas that are getting hit with these 50% tariffs. And then you were going to add on the things you fill your house with, vanities and kitchen cabinets. So there is an incentive there. There is a sensitivity there that we're seeing come through on the decision of pulling back some tariffs. Other areas have been food, for example, that they reduced tariffs on about 200 plus products. They have been pretty stubborn on the steel and aluminum, though, because this is the notion that the U.S. wants to build domestic capacity. Yep. I would say if they're going to ease up on anything, it's more likely going to be aluminum than steel, because they have the least amount of capacity there. So they would be absorbing most of the price increases in that industry, because in steel they have excess capacity and they can grow that a little bit with less pain on the price point side. But really, I think it would be dependent on Carney. Could he convince the U.S. of being a reliable partner? And probably more likely, instead of just reductions in tariffs, we'll see quotas. So up until X amount, you get this favorable rate. And then after that, these more punitive rates kick in. So we might see hybrid deals like that. And I think that's probably more realistic on the path we're on.
What other, again, coming back to Canada and thinking about, Kuzma is going to Kuzma, whatever it does. Yeah. We're going to wait and see what that's one too. But in terms of other trade deals, when you hear the news of the Prime Minister and ministers traveling around the world, what ones are you paying attention to?
Well, if you look at what has been accomplished, I think it's in a short time. I think it's surprised most economists that we have increased our shipments to about 27 countries in 2025, and almost offset all the loss that we've had to the U.S. So that's a huge surprise in how fast that could happen, because you already have market presence. Canada does have the greatest amount of free trade agreements of any G7 country with other countries. So the agreements is not the issue. It's making sure the demand is there in other regions and repairing relationships that have been damaged over the year. And that's why you saw Carney in India and talking with China as well. So especially like China and India, these are really big markets, right, for population and growth. So those are areas I would pay attention to, not necessarily the EU, where we already have established agreements and very like-minded policies. I'd be interested to see if we can make progress in markets where we've struggled in. And we are shipping more to China, but it's specific to oil resources. And then again, like, if I go back to that regional disparity that's happening in Canada, Ontario's oriented to the US, whereas, BC and Alberta and others would be oriented to other markets. So even as we build out demand in other markets, it's really important for a province like Ontario to make sure they're participating in those shipments. And to get things out of Ontario is not quite as easy when you're a port city.
Here's a question for you that just came to me, lucky you. As we see the Canadian economy evolve over the next little while, do you see changes maybe in regional prosperities, in shifts in where things are moving? I mean, we can spend a lot of time talking about Alberta and, and oil and, timber on both the coasts. I don't know, like, do you see something evolving?
Yeah, hopefully in a positive direction, because I think Ontario is the majority of the population base of any province. It's the largest. And we are talking now about developing critical minerals and other factors, and the degree that we can do EV production and build in some foreign investment on that side as well. We've seen some progress there. So it's just not an instantaneous rotation. And I think that's the challenge, that there will be still some displacement of labor through those periods. Also, like a lot of universities, a lot of talent in the province, a lot of opportunity on the AI, digital areas of the future of growth. And I think Ontario is incredibly promising from that perspective. Mm-hmm. It just needs to build to scale, and we need to see those outcomes over time. And it's like we're just now learning where we need to pivot to. We just got to see how we do on those pivots.
What do you see in terms of AI for Canada? I mean, we all, in terms of the markets, I mean, it's been a juggernaut. We've all watched it in terms of what it's done. And, I'm a bit of a nerd, so I'm always constantly watching the latest news about, Canadian kind of investment firms, investing in robots being manufactured over here. And you just think, wow, we live in an age of robots. What do you, though, see from an economic standpoint for AI to start to materially matter? Like, is it productivity? Are we all going to have a robot in our home next year? Vacuuming my floor, one hopes. But anyway.
Oh, that's the Roomba.
That's the one. I mean, a humanoid one. Yeah, no, the Roomba.
Kim.
I know. Get with
think
it.
Bigger. Think bigger. I want the robot to cook for me. So, interestingly enough, we are not as strong on AI adoption as what we're seeing, especially when we compare ourselves to the U.S. Not a surprise, hence the stock market reaction of AI dominance in that country versus here. So the positive is there's a lot of upside to that on adoption. So the industries that are mirroring the U.S. on high adoption rates is the finance industry, the professional industry, and information technology, which makes total sense. So those three industries are behaving more like what we see in the U.S. Interestingly, we don't see the job losses like we do in the U.S. So where you would have read headlines about youth unemployment being higher, some have reported double-digit declines in people in the age of 22 to 25, where you have intensive AI adoption. That's an American story right now. It's not a Canadian story. What we are seeing in Canada is more companies reorienting, retasking the labor as opposed to cutting, and maybe slower hiring, but nothing that would suggest the patterns of the U.S. are mirroring themselves here. So that's a good news story for Canada. But the bad news is outside of those three industries I mentioned, the adoption rates are about half of what you see in the U.S. So to imagine what we could be in 5-10 years, I just always, as an economist, I want to make sure we're not imagining continuing to be a laggard. We do need to get more and more of our companies in the adoption era. And I think one of the challenges for Canada is we have a much bigger base of small businesses than they do in the US, and we have a much bigger base of older, smaller businesses. So if you look at the percentage of small businesses that are 11 years old and older, it's 60% in Canada versus 40% in the US. And the reason I say that statistic is because it matters for innovation and technology. Young businesses define creative destruction. They're the ones who are innovating and going in and out of markets. You end up with what's called a birth-death rate with small businesses, ones that don't make it versus do, but the ones that do, wow, look out, right? Those are the ones that are hiring and innovating and creating that productivity push and putting that robot chef in your house that I need. I don't know if you need it.
I need
certainly
that too.
do.
You've never eaten my cooking. Trust me, I need it.
Oh, good. So I think that's what we're missing in Canada, and that's my hope for the future, is that we start to see these small businesses be a bit bigger on the risk-taking and the growth side of it, because AI will compel and the technology will compel those benefits in terms of adoption, and then be complementary. So what we're seeing so far is much of the AI is complementary to enhancing people's productivity as opposed to removing them necessarily from the jobs, which we're seeing a bit more on the US side.
Okay. Let's stick with the youth piece, because when you talk about like young businesses, creative destruction, entrepreneurship, great way to kind of start things off. But when you look at the outlook for young Canadians, you mentioned rents, seeing some positive, it looks like there in terms of like lots more supply on. Maybe it's a little bit easier to buy a house than maybe it has been next year than in the past. What about employment? Like, what's the outlook for young Canadians right now?
Well, the youth unemployment rate is high. However, we did analysis that looked at the rate of increase on the youth unemployment rate versus the deceleration in economic growth. That correlation remains very consistent to history. So that's telling us that the rise in the youth unemployment rate is not related to like a technology displacement. It's literally related to the business cycle, the slowing of the business cycle. And
can you just tease that out when you say, like, so how does that work? Business cycle slows and therefore
less demand for labor. And we know that when demand for labor slows, it disproportionately always hits the least experienced. Even though they're the cheapest to hire, they're also the least experienced and at the early stages of the career, the least productive, right? Because they're in the learning mode.
Which hurts the most because it's the early stage of their career.
Yeah, exactly. That's why you get so much scarring in periods of recession that it takes them like 10 years to catch up on where their wages would have been had they not graduated in a bad year. So, so that's the correlation I'm speaking to, that the rise in the youth unemployment rate so far seems more related to just what's happening in the economy, rather than something idiosyncratic to technology and innovation and productivity. Doesn't mean that won't come. Like, we are seeing it happen in the US, and the higher that companies, adopt and adjust to the AI movements, we could see that happen in Canada as well. So it doesn't mean it's not there. It's
not here yet.
Not here yet, right?
Can I ask you about, and I'll jump back into some of the numbers again. So when you think about currency outlook, and then obviously Bank of Canada, you said you think the Bank of Canada is on hold, you think, for a while.
Yeah.
So when people want to know what the loonie is going to be worth, what do you think is going to happen for 2026?
We already had an appreciation of about 5 to 6% last year. And I think the U.S., really, when we're making a call on the Canadian dollar, we're making a call on the U.S.
Yeah.
And I think that the U.S. will probably be relatively stable this year, and I don't think we'll see much movement on the Canadian dollar. Like maybe 1 to 2% appreciation max in my mind, but nothing more. Now, if we get this fantastic deal on Kuzma and all the risk goes away and uncertainty, you could easily see another 5-6% pop, but I just don't think that's the most likely path.
Okay. What about when you think about? I want to ask you about the K-shaped economies, because I know you mentioned it when you talk about
Everybody
the U.S.
knows this letter now in the alphabet.
I know, right? Okay, Kim, it's a good letter. But I was thinking, I was taking some of your writing, and I was thinking it's a capital K in the States and maybe a small K in Canada,
Yeah, that's
right?
a good way of putting it. Yeah.
So, but maybe just explain like what you're seeing,
Yeah.
and then maybe emerging in Canada and why it matters.
Okay. Yeah, so this is interesting because it's almost like building on the theme of what we were just talking about. Like we're seeing, when we were talking about AI, I'm like, here's what's going on in the U.S. We're not seeing it in Canada. And then when you talk about the K-shaped economy, that's actually a concept that has really been driven by what the U.S. is experiencing, not quite there in Canada. And these are good things in terms of the dislocation of income and labor. So what's happening in the US is where you look at the distribution of income, more and more of the income is flowing up into the corporate profit channel versus the wage channel. And part of that is the technology story with these behemoth companies, right, that pull up that side. But not solely, because it's been a long-term trend. It's been happening before 2020, 21. So you just see this constant migration. So the K is that side of the upper side of the K being corporate profits rising as a share of total income in the US economy, whereas wages are falling as a share.
Yeah.
And so that's where you're getting that split in that K. And then you could kind of drill down further. So then if you say, well, if we take that wages portion and we look at the wealth question, again, you see it. So you see that wealth going to the top 20% of the population rising relative to the wealth going to the bottom 40% of the US population. So again, that K, that split. And then you can say, oh, okay, let's drill down more. And now let's look at wages of people who are high, middle, and low skilled in their jobs. Again, you see it. So what you're seeing is a faster deceleration in wages in the low skilled versus the high skilled, which makes sense because, with the AI revolution, those people are going to be really well compensated. So you can see there's these Ks showing up, and that's why people are saying that you're back in the K-shaped economy. That concept originally came out of, not originally, but was really reinforced during the pandemic when people were saying there were the have and have-nots of who had to go into work, who didn't, and where the income was derived. We're just seeing it now reinforced further in the US, but for different dynamics. Then if you dovetail it into Canada and you say, oh, well, what's happening in the wealth side on Canada? It's the opposite story. So the data that we looked at, now it only goes to 2023, but we already can see based on the 24 and 25, the way the stock markets perform, that we think it's a reinforcement of what we saw in the past. But we did see wealth of the bottom 40% of wealth holders rise 7 times faster than those of the top 20%.
Sorry, was that in Canada or in the US?
Yeah, no, that's in Canada. No,
That's
the US
great.
would be the opposite story.
Yeah.
So there's catch up happening in the Canadian economy, and you're getting this compression of the inequality curve. So that's not a bad thing. It's a good
That's
thing.
healthy.
Nobody feels that way, by the way.
Yeah, no, I know.
Ask the average Canadian. Nobody thinks this way.
Yeah.
You never feel like you're caught up. But it has been, from a data perspective, very evident that that bottom portion of the population has improved in some of these metrics, wealth being one of them. And then the same, when I look at the wage increases of people who are in high adoption AI industries versus low adoption AI industries, and you look at it by age, youth versus those 25 to 54, the wage growth seems very similar between these groups. There's not a one group suffering and the other one doing really well. It's a very even pattern, whether you're in an industry that adopts AI a lot or doesn't, whether you're 25 or 54, so we're getting very similar patterns. So there's not a K showing up from the metrics that we look at when we compare ourselves to the US. The one area it shows up is if you're export-oriented or not export-oriented, and that one makes sense, right? So there, you can see where the industries and the profits and the growth happen. It's in the non-export oriented industries. And so you can say, okay, there's a K there that's happening between that schism between the two types of businesses, but we know precisely why that's happening, and some of that can be reversed.
When you think about, I'm going to kind of wind up here because I could talk to you all day, and I will at some point. I'll do it again. But when you think about all the investment that is coming into Canada, or at least the government doing its best to attract new investment into Canada, where are the opportunities for people? What do you hear about where it's there's going to be a lot of interesting things happening here?
Well, the defense industry, anything defense, anything supply chain defense, a feeder into that. That's tremendous opportunity. It hasn't been there for generations.
Yeah.
So to me, I'm excited about that, and we need it. And because that industry is so high on intellectual property and just adoption of technology, that is a good place for Canada to grow out. Excited about that. Resources, we know foreign investors are asking us when we're talking with our clients. A lot of them are asking us about the resource sector. A lot of excitement there. I would expect that to remain the case, but that goes back to maybe the earlier point in our discussion about what does Canada need to deliver on? It needs to deliver on getting some of these projects finalized and off the ground. But that's an exciting area, I think, as well. I'm excited that housing affordability is improving. I know people don't really feel it or think about it, but it has. If you look at home prices from the peak, just in Ontario, they've come down, I think, about 13%. Wages have gone in 4 years, and wages have gone up about 18%. That's a 30% delta between the bottom and the top, right? So there's an affordability aspect there that's providing an opportunity for youth to finally get into the market. And yeah, it's still going to feel tough. We've all been there, and it's tougher for this generation. But there's an opportunity that finally opened up after we were in this really long time bull market in housing. So I think good on that adjustment to continue to happen. So a lot of positive things, and which I hope to see in the next budget is more tax reform.
Well, this is I want to get into your wish list.
I led you into a question.
We know, like I said, there's some good things happening in the economy. But what do you think we need to see more of to get more good things happening?
Yeah. So what we saw in the budget was a reinforcement of policies that already exist in Canada. So it was a bit of a safe play. So, for example, the capital cost allowance, which they renamed this super productivity something, I can never remember it, was a policy that was already in existence under Trudeau, had expired, and they extended it, but also expanded it, allowed for more industries like processing, manufacturing processing to be included. So that's good. Shred, science, like a subsidy for the science area and research area, same thing. Right, increase the allowable amount for expensing, and have it on out to 2030, I think it is. But it's an existing policy, and they just kind of enhanced it. What we didn't see out of the budget, what I hope to see, is really starting to tackle the harder areas, the more new and novel areas. And one of the problems we have in Canada is really the complexity of the tax code, the inefficiency of it. The example I'm often, pounding the table on, because I think it's intuitive and offers people a really stark example of how you could have a tax policy with good intentions that has bad outcomes, and it needs to be fixed. And this is this is a report done by Statistics Canada on small businesses, and it shows that we have a tax policy that has very favorable tax rate up until $500,000 in taxable income if you're a small business, like very low. I think at the federal level it's only 9%. And then it flips into accelerating in the tax rate. And so what the data show is you get this massive amount of bunching of companies who stay at the 500,000 mark. That's not what a tax policy is intended.
It's a disincentive to grow.
To do. It's actually not even just a disincentive, it's rewarding small, as opposed to rewarding medium and large or growth. And then it gets even worse, that this policy, the last time that threshold, 500,000, was lifted was under the Harper government. And it's not inflation indexed. So if you inflation index, that threshold should actually be 700,000. So you're not only incenting small, but you're incenting it not even to keep up with inflation. It's regressive. And then you get the behavioral aspects when you look at how people respond to taxes, right? So if you look at the number of businesses that have incorporated who are single proprietary, they have no payrolls, no employees, that is now exceeding the amount that actually have payrolls. So people are incorporating to take advantage of the lower tax rate, because if you're like you and I, a T4, and you pass the 220 or 230,000 mark, you're paying a marginal effective tax rate of 53%, as opposed to half that if you were an incorporated self-proprietor without any payroll. So we are absolutely incenting the wrong behaviors, but all the behaviors are telling us low taxes matter. We will create a construct of our business or behaviors to try to get the best deal for ourselves, our families, our households, right?
Yeah, human nature.
And so that absolutely needs to be fixed. And
how probable is it that'll get fixed in the near term?
I will be pounding this table until it's fixed. It better get fixed in the next budget.
You heard it from Beata. What is the final thing I should ask you? What have we not talked about that you think people should hear? Or what is just one message you want people to hear? And in terms of the outlook for Canada for next year.
So we obviously want to be positive. We're doing a little bit better than we thought. but we're, like I said, like we're resilient but restrained, not where we want to be. I think that the thing we got to get our heads around as Canadians, because I watch the news every day, it's part of my job, always talk about CUSMA or USMCA, however you want to refer to it, and how important it is for Canada. Let's assume it ceases to exist. Like I said, it's not in our control fully. We should be focused on fixing our own house and what that looks like. And I think for Canadians, part of fixing your own house is really, we're going to have to go through a painful adjustment. And I don't think we're quite there in what that means. So an example I just recently gave is when you look at when people say, where would you like to live if you can move or, immigrate to another country, Canada is often ranked quite high, right? We're often in the top 3 choices of people. And you ask them, why would you choose Canada? And it's one, for its beauty, right? The nature and awesome scenery we have. And then the second factor is our social system. Great, right? Like we do have a terrific social system. However, when you ask people why they go to the US and have put them at the top of the list, it's for economic opportunity, the ability to take nothing and turn it into something. And I think that we have to get a little bit more of that culture here in Canada. We have to attract the money. We have to attract the high talent. We have to attract the risk takers. And that means we can't keep having budgets focused just like so heavily on the social element. Now, the last budget by Carney wasn't, but if people think like, that's it, the next one's going to be like, what else are we getting? I think we have to be careful in that we're going to need to stick behind the growth model of businesses for years to get this right, so that we can get into a position of having an economy that is a job generator with sustainability and high wages.
Appreciate your thoughtfulness. What a great discussion.
Thanks, Kim.
Thanks, Beata.
Thanks for tuning in to this episode of the Money Talk Podcast, brought to you by TD Wealth, recorded on January 7th, 2026. The information contained herein has been provided by TD Wealth and is for information purposes only. The information has been drawn from sources believed to be reliable. The information does not provide financial, legal, tax, or investment advice. Particular investment, tax, or trading strategies should be evaluated relative to each individual's objectives and risk tolerance. The views expressed are those of Beata Caranci, Chief Economist, TD Bank Group, as of January 7th, 2026, and are subject to change based on market and other conditions. Certain statements in this presentation may contain forward-looking statements that are predictive in nature and may include words such as expects, anticipates, intends, believes, estimates, and similar forward-looking expressions or negative versions thereof. Forward-looking statements are based on current expectations and projections about future general economic, political, and relevant market factors, such as interest and foreign exchange rates, equity and capital markets, the general business environment, assuming no changes to tax or other laws or government regulation or catastrophic events. Expectations and projections about future events are inherently subject to risks and uncertainties, which may be unforeseeable. Such expectations and projections may be incorrect in the future. Forward-looking statements are not guarantees of future performance. Actual events could differ materially from those expressed or implied in any forward-looking statements. A number of important factors, including those factors set out above, can contribute to these digressions. You should avoid placing any reliance on forward-looking statements. TD Wealth represents the products and services offered by TD Waterhouse Canada, TD Waterhouse Private Investment Council, TD Wealth Private Banking offered by the Toronto Dominion Bank, and TD Wealth Private Trust offered by the Canada Trust Company. TD Bank Group means the Toronto Dominion Bank and its affiliates, who provide deposit, investment, loans, securities, trust, insurance, and other products or services. The TD logo and other TD trademarks are the property of the Toronto Dominion Bank or its subsidiaries.